There's just one story dominating the financial markets this week, and that's the looming crisis over raising the debt ceiling. What does it mean for your investment outlook? All this next on Quartz Smart Investing. Thanks for joining us. I'm Merrill Brown. Our guest today is Carin Pai, Executive Vice President, Head of Portfolio Management, and Head of Equity Strategy at Fiduciary Trust International. Welcome, Carin.
Thank you, Merrill.
These are confusing times. Wall Street is edgy. There's not even a clear way to get a sense of what's going on in the negotiations between Speaker McCarthy and President Biden. Adding to the confusion is we don't even know when the so-called X date is, when default might happen. How do you assess the prospects here?
It's a challenging environment, as you mentioned. And I think in addition to the debt ceiling, there's a lot of other concerns as well. But obviously the debt ceiling is sort of front and center right now. And I think one thing to keep in mind is that this probably is a short-term phenomenon, and that over the long run, we've seen these situations arise, and we have not seen actually any time in which we have allowed the debt ceiling to lapse, right? So I think that at the end of the day, we probably will find a solution and a compromise. I don't see the probability of a crisis really resulting from this negotiation, very much like what we have seen in the past. We've always been able to find a solution.
But we're more divided as a country, and the politics seem more dynamic and dramatic than ever before. Isn't that reason for concern? It
is. I think that's a fair point. I certainly think that it's a cause for concern, cause for some caution here. So, generally we're not recommending that investors take on a lot of risk at this time, because as much as we think the probability is that we will be able to resolve the debt ceiling, we do think that there's a small chance, right, that it gets delayed. Negotiations go past the so-called X date, and therefore it could create a lot of market turmoil in the short term.
You're advising investors to think defensively and focus on high-quality investments. How should people be approaching their portfolio?
Yes, absolutely. This is not an environment where investors should be taking on a lot of risk. First, we are recognizing that the market valuations here are not cheap. Market valuations, in fact, are at the higher end of the range. The S&P is trading at around 18 times earnings. We've got corporate earnings that are in decline at the moment, second quarter of consecutive negative earnings. We also have concerns about the consumer slowing down. Corporate spending is slowing down. So the economy is going through a slowdown, and this is not the time for investors to take on more risk. They should probably be looking to de-risk their portfolios, or certainly minimize their risk-taking in this type of market, and staying very much on high-quality investments, thinking about companies' balance sheets, thinking about their competitive positioning, pricing power. All of that is going to be really critical to weather a slowdown in the economy.
You're concerned about at least a bit of a correction coming up in a slowing economy. How might that roll out?
Yes, so we are seeing a slowdown in terms of employment. Right now, employment here in the U.S. is still pretty resilient. The economy is actually surprisingly resilient here. But we do expect the economy to sort of continue to see these rolling slowdowns. We are seeing companies announce layoffs, right? I think it will take some time for us to actually see that come through in terms of the employment data. We're already, I mentioned consumer spending slowdown. It started with sort of the lower end consumers slowing down, but now we're actually seeing higher end consumers peeling back, their spending. And we are starting to see that, as a result of a slowdown in the housing market. Home prices have softened, home sales have slowed down. So these are all sort of data points that suggest the economy will probably continue to decelerate here.
You're also concerned about inflation, especially the fact that it's continuing at a higher rate in Europe than here. Mm-hmm. What does that mean for investors?
So we still relatively like the U.S. market over international markets for that reason that you mentioned. We do think that the risk of inflation, or the pressure from inflation, is a bit higher in Europe and also outside of the U.S. Although their economies are, I would say, re-accelerating a little bit here, but they have a tougher challenge with inflation. Inflation is 7% in Europe right now, so it's a very high number. And there may be some disappointment in terms of how quickly the economy reopens in China, which has contributed to some of the reacceleration in Europe because of the service economy that's kind of benefiting from China's reopening. But I do think that it probably will be challenging for international markets to continue their gains this year, given the stickier inflation that we're seeing there.
Thanks, Carin. We'll all be watching Washington as the week rolls on toward Memorial Day. Thank you for coming.
Thank you.
For more of today's top business news and insightful analysis, stick with QZ.com.